From a tax attorney's perspective, how can I keep more of what I'm earning by understanding the tax game?
One of my favorite tax deductions right now is HSAs. It's a triple threat because you get a deduction, it grows tax-free, and you never pay tax on it.
You talked about the buy, borrow, die strategy. Do you think the strategy is a good strategy?
Buy, borrow, die strategy is really simple. Buy an asset, let it appreciate over many years. If I never sell it, I never pay any tax on it. And it works on multiple assets. It can work on art, it can work on real estate, it can work on...
What are some of the strategies that is mostly hype?
So some people are like, I pay no tax.
I pay no tax on top of it.
I'm like, you're an idiot. You know, the Bitcoin bros just got humbled. Money is a little bit like you put it all in one big pile, it usually stinks, but if you spread it around, stuff grows.
What are some of your favorite assets for building wealth?
You want to be a millionaire? Set up an account, Fidelity, Robinhood, Schwab, any of them. Have it on auto where it just sucks it out of your account every month and then lose the password. I'm a legacy planner. I believe you should be doing things that are going to benefit your kids' kids, maybe your kids' kids' kids. You have to be rich to do it. I don't care how wealthy you are. You can absolutely create a legacy, period.
How can you make your assets invisible from creditors, the government, lawsuits?
I would say you use a framework like this, and I use this example.
Toby, Mathis, welcome to the BetterWealth Show.
Hey, thanks for having me.
It is an honor to have you on. You have almost 600,000 subscribers. Maybe at the time of this recording, we'll be over 600,000 subscribers. You are one of the leading educators, especially online, when it comes to asset protection, tax strategies, and you have so many amazing videos. I'm very grateful we got connected recently, and we had a conversation, and I didn't know exactly what to expect, and you were one of the most present, down-to-earth people I've ever had conversations with, especially at your level. So I want to thank you first and foremost for what you're doing. You are providing so much education that people are charging a lot of money for, and you're giving it away for free. And I'm excited to create like a masterclass on how the wealthy are really doing it, but then how ordinary people can take some of the first principles and do what the wealthy families are doing.
No, you're too kind. I always look at it just like, hey, be a teacher, but even more so, I don't know about you, but I grew up without in a family that didn't talk about money, didn't know what to do, didn't really have that guidance. And I had mentors over my life that would say, hey, here's what you should be focusing on. And so I've always tried to say, hey, there's a lot of people that don't have that. So if I can do simple things like, hey, live off of less than what you make, and here's what you do with what the difference. Here's how you can minimize your tax. Here's the type of assets you want. Hey, it's rent, royalties, dividends, interest, short-term capital gains if you sell options. Like there's types of income that you should be focusing on. You don't have to work all the time. You get beat up if you work all the time. I just try to be that guy.
Before we jump into some of the juicy topics of these strategies and all, I think it would be helpful to get some of your backstory because, we don't come out of the womb saying we want to learn about tax strategies and estate planning, and you've had an amazing career. But I would find it valuable to hear, like, how did you get into this? And then what were some of the key pillars to your story?
Yeah, it's kind of funny. So my dad worked at Boeing for his entire career, started there in Alabama, went to Philadelphia, out to Seattle, and would never let me go. I think I went to the Boeing facility twice in my entire life. He was like, don't do this. But he didn't have it, he didn't tell me what else to do. He just said, don't go to college. I actually had that conversation where he sat down and said, college isn't for everybody, go learn how to paint houses. Those guys seem to do pretty well. Go learn construction, go learn business. And I'd say, from who? And he'd go, well, go find people that run businesses. Okay, Dad. I got lucky. I got a soccer scholarship. So I never planned to go to college, but I was able to, somebody said, hey, come play soccer. And I was like, oh, sign me up for that. That was the only reason I went to college. Law school was because I had a really good mentor. I did find somebody who said, hey, you know what? If you really want to be successful in business, you need to know the laws and you need to know the taxes. You should go to law school. And so this gentleman, who was kind of a mentor to me, his son and I both went to law school, not to become lawyers, but to be better business people. And then when I got out, started doing practice, and I realized what I really wanted to do is talk to people about their businesses and the things that I was learning and implementing. And I found them fascinating. In talking to successful business owners, I got in with a good group of business owners, and they were all very open to share. And I just took those concepts, and that was 30 some years ago. And I've just been pushing ever since to share those with other people so that they could take advantage of it.
So I'm always curious about like the first principles, like the basic frameworks of if you were sitting across the table from someone who's like, okay, I want to know the secrets. And if you're listening, I'm using quotations because I have a love-hate relationship with the word secret. What is the framework to how we think about business, how we think about money, we think about certain asset protections? Like I think sometimes we go right into this is a strategy, and sometimes we forget the basics. And I'm curious in your journey, if you had to like give me the basic, like, okay, well, let's start from level one and then we'll build on. But if you don't get level one, we could talk about advanced strategies, and you're one step away from unfolding everything if you don't have the basics.
Yeah, I would say the first thing you do is you got to learn how to make money. And the wealthiest people tend to be business owners. Or you find something that's really valuable and you can maybe get a really great career, maybe an engineer, a doctor, a lawyer, something where you're a high paying job, but that's not going to make you wealthy. I think Dave Ramsey did a study, Steve Hogan, where they interviewed 10,000 millionaires, and the top three categories weren't high paid. Like one was engineer, the second was accounting, and the third one was teachers. And I think that what that demonstrated is that you don't have to be in a super high earning profession to actually become wealthy. It really comes down to knowing what your income is, comparing it to your expenses. I think Dave says act your wage. I don't know why that keeps sticking in my head. But there is something to be said for, hey, you first got to make the money. You got to act. Don't try to look rich. Put money into assets that are going to pay you. And there's definitely a system for doing that. And I found that when I'm working with people, and we do tens of thousands of returns. I've worked with tens of thousands of investors over the years. Anderson has about 500 employees. We're nationwide. We're part of a global company. We got over, I think it's 800 employees worldwide. And I learn from our clients, and I'm always trying to pick up things because I just, like with you, I would pick up nuggets and I carry them along with me and I share them with other people. That's how I kind of look at it. And the things that came back were, it's easier to increase your income than it is to cut all your expenses. And it's a joyless life if you're not doing things and having experiences. But on the same token, you got to keep those expenses underneath your income. And I know it sounds easy. Somebody's out there saying like, "What I spend every dollar." I'm like, yeah, well, okay, really examine what you're spending your money on and examine what other time you have to make wealth and whether you can generate, whether it's side gigs or something else, because it's kind of one of those things. It's like a snowball. You got to get it. You got to prime it first. You got to start with something, and then it'll compound interest will do a lot for you. And that snowball will get bigger and bigger and bigger, but you got to fight like heck for that. I would say the first $100,000, you got to fight for it. And the easiest thing to do is to add more income by going out and learning new skills and maybe supplementing it. I don't care whether you're wholesaling in real estate and you're like, hey, I'm just going to learn how to be a bird dog for other people with money, and maybe I get paid and I'm going to take that money when I get paid and I'm going to put it straight into dividend producing stocks. I'm going to learn to write covered calls. I'm going to learn how to do the wheel strategy. And I'm going to learn how to make money four ways on that type of investing. And then I'm going to go into REITs, or, everybody wants to get into real estate. And I would say, make sure you have a good cash position before you do that, because a new roof's expensive when you're doing rental properties and things like that, and there's like pumping the brake type things, but you build a system. And I guess it's a long-winded answer to your question. I would say that the people that are successful usually have a system that they're following. And I don't care what system it is. I've gone over a whole bunch of them. I use 70-30 rule, try to live off of 70% of what you bring home. And then 30%, I believe 10% of of the total. So 1/3 of that 30% or 10% total goes to giving. 10% goes to paying down debt, like not paying your minimum payments, but paying off debt, because I think debt will choke you out. I'm not a big debt fan. Leverage your debt, whatever you want to call it. They're different, but I'm not a big fan of it. And then make sure that you're investing. So 10% goes into investing. So the 70-30 rule is really simple. Try to make sure that you are keeping your expenses at 70% of whatever you're bringing home. And if you make a lot of money, then you can live really large. And what will happen, by the way, is over time that 70% will lower. And it seems in the very beginning that 70% you might not be able to do it. Like when I was going through college, I didn't have any money. So the idea of giving away 10% was crazy. So I would give time.
Right.
I would do that, go volunteer, and I would try not to go into debt. Like if you're 18 and you're listening to this and you don't have debt, good, stay there. But I want to do this. I want to do school and everything else. Find a way to do it debt free. Work your butt off. I worked 3 jobs when I was going through law school. Just fight so that you don't get drugged down by that compound interest. It'll work against you. It'll drag you down. Your student debt will still be there. And in 20 years, you'll be suffering for it. Do whatever you can to try to stay out of that and then invest. And I don't care if you're 18 and you get an extra $2 or $3, put it into the market because it triggers something in your memory. They call it frequency illusion. Kind of goes like this, Caleb. If you were thinking of buying a new car and you said, geez, I'd really like a pickup truck, and I'm thinking about the Toyota Tacoma or the Tundra, the next thing you know, you're seeing them everywhere.
Yeah.
Right? It's because they were there the whole time, but your brain said it's not relevant to you, so we're not going to pay attention. So just by investing, even if you just bought a couple shares of stock, you're going to start paying attention to the market as a result. You're going to start paying attention to the numbers of those stocks, and you're going to learn. And then that's going to serve you the rest of your life, and then continue to do it. And over time, it's amazing. So I always look at, we talked about the top 10 category or the top 3 groups that are millionaires in the United States, and teachers being one of them. Most of those folks don't make over $100,000 a year, but what they do very, very well is put money in their 401ks, and they become 401k millionaires. And I don't care what Grant Cardone and all these other folks say, and they're like, you're a schmuck, a 401k, you got to pay tax when it comes out. Yeah, it's going to be a very low tax bracket when it comes out, or there's ways to rescue it. If you get too wealthy and you have a tax problem, congratulations. There's a lot of things we can do to offset it. But what it does is it puts you on a discipline of putting it away. And then you're going to have people say, well, you're getting ripped off in your 401k. You should be doing everything yourself. Relax. It works. Yes, you can do lots of other things, but the reason that a category of a profession that is not a high-income profession, the reason that those people are in an inordinate amount of the millionaires out there is because they are following a system. And if you learn to follow a system, it will serve you well.
I love it. I had the pleasure of actually interviewing Ted Benna, who's the person that's like noted for discovering the 401k, and it's a fascinating conversation. And I asked him like what he loves most about the 401k, and he's like it's hard, they make it hard to get your money. And it's interesting because the same people, Grant Cardone, that will say that will crap on that system. It's like sometimes your access to money is your greatest problem because most people are not reinvesting that or finding another asset that's they're usually spending it. And so now you're creating a system that automates cash going in and then it creates friction of it going out, and voila, 30-40 years is it's a good equation.
You just hit the nail on the head. You got to make it easy and auto magic. I used to joke, I said, here's a wealth hack. You want to be a millionaire? Set up an account, Fidelity, Robinhood, Schwab, any of them, and have it go into a total market fund or just the S&P 500 and have it on auto where it just sucks it out of your account every month, and then lose the password. Just lose the password and check back in 10 years, you're rich. Yeah. Check back in 30 years and you're a millionaire. Like if you just put it on there, I think it's like $50 a week or something along those lines. If that's all you did, you're a millionaire. After 30 years, you've got just a ton of money. So, but you got to make it to where you can't get in the way.
Right.
And then you go out there and attack and bring in more.
You can be your greatest asset, but you also can be your greatest liability. I have so many questions for you. Why are entrepreneurs such poor investors? It's like the what helped them make money. I know more entrepreneurs that lose money in investing, and I'm like, you would just be better off putting your money in a checking account versus all these speculative investments. Why do you think that is?
It's because what makes them great investors, you got to be able, to be an entrepreneur, you have to be able to take on risk, and you have to do things that don't make a lot of sense, and you get good at it. and you get kind of shiny toy disease where everything's an opportunity. Investing is the opposite. You have to resist the temptation to touch it. You got to let compounding do its job, and that takes time. And it's like, what's a good example? My mom was always like, if you open up the oven where there's a cake in there, it's going to fall type thing. Like say, you can't mess with the cake. You got to let the cake do its thing, and you got to follow the recipe too. The recipe says, if you're making a cake, this much flour, this much sugar, don't start swapping things around because you're smart and you think it's going to be better, or I can cut corners. You follow a recipe and you don't mess with it. And as an entrepreneur, that's not normal, right? I'm a pivot, I'm fleet of foot, I'm out there taking risk, and investing, it's like, don't touch this.
Yeah,
it's MC Hammer. Can't touch
I love
these.
it. That would be a good t-shirt to have, especially when you're thinking about investing money. So as you were talking, I wrote down make, keep, grow, and then I wrote protect as question mark, because I'm a big framework person. So it's like number one, obviously making money. Keeping it is where most people are not winning, and pretty much society is built to extract our money from us. And obviously a big place where people are losing money, especially if they're high income earners or entrepreneurs, are their lack of understanding of taxes. And so, it is not going to be super fun to hear, but if you got really intentional about where your money's going, because a lot of people are just spending and consuming at a rate that is actually not in alignment to their values, but they're doing it for other things. We could have a whole episode on that. I don't necessarily think we need to touch too much on that, because while I have the tax attorney here, I want to be able to ask you some questions around tax strategy, and then obviously the asset protection and estate planning. And so anything that you want to mention before we dive into some of those things on that framework of make, keep, grow, and protect, and would you add or subtract anything from like those four like core things?
Well, Anderson's Mission, the company that I helped found and that we've grown, and is the mission statement is preserve, protect, and prosper. And so you're hitting all those. It's preservation, making sure that things don't get spoiled. The income that you work for so hard doesn't just get wasted. Protect it from lawyers and snoops. Don't let something come in and steal what you've worked so hard for. And then prosper, allowing it to grow and bless future generations. And I'm a legacy planner. I believe you should be doing things that are going to benefit your kids' kids, maybe your kids' kids' kids, if you want to think that far. And anybody can do it. I don't care how wealthy you are. You can absolutely create a legacy, period, because we all have a life and we can insure it. And so we can set up a plan. And if I don't have the money, I can buy a cheap term and policy. And if I die before I get wealthy, that money goes in there and into that plan and it gets executed. And maybe it's education, maybe it's for travel, maybe it's mission work, whatever it is for your family. You could do it with next to nothing. And we've been told that you have to be rich to do it. You don't have to be. But preserve, protect, and prosper is what we use at our firm, and is the framework that we use.
I love it. Just like you mentioned, when you start investing, now you become more aware. If you start doing certain estate planning and think multiple generations, you are going to be a different human. I actually did a video a couple of years ago, and I want to like bring this back as like one of the core things I talk about is being the main speaker at your funeral, which sounds crazy and weird, but imagine you doing the work of like shooting a video assuming that you're dead and you speaking at your funeral.
Oof.
What would you say? Who would you say, who would you talk to? What are the things that are most core to you? You do that, you actually live differently while you're alive. Just the person that can make that video or write that obituary or do the planning shows up differently. And it's like, yeah, not only is the next generation better off, but you actually are better off while you are alive. Have you seen that be true just in the people that you've worked with, that they actually can make more and grow their assets better and actually live more intentionally when they do proper planning?
Yeah, I used to use an example that if I gave you $100 for your child, I don't know if you have kids, Caleb, but
I have a 1.5-year-old.
All right. So if I gave you $500 for your 1.5-year-old, and I said, this is for your child's future, versus if I just gave you a $500 Amazon gift card, you're going to treat those very differently. You're going to treat the $500 that's dedicated for a purpose with far more reverence than you are going to be frivolous money that you think, oh, I can just spend it on whatever. And so when you create that legacy, and I think I shared with you the Steve Harvey video that I like, where he's talking to his friend's grandmother who's about to pass, and she says, do you know your great grandfather's name? And he says, no, I don't. She goes, that's because he didn't leave anything for you. And a lot of people walk away and say, oh, they were talking about money. And I'm like, it's not about money. It's about values. If you leave something of value to somebody, and I use the example of a client that I did a estate plan for, they like to travel the world. They said, you're a better human being if you get outside the borders of what you're comfortable with and you go out and see what other people are experiencing. And so they really wanted their family to be travelers. And so they didn't have a ton of money. So we set up a trust, which is really the only way you can do it, guys. Everybody's like, will or trust or will. Will works when you're dead and then it gives your stuff away. If you want to create a legacy, you got to be more intentional. It's going to be a trust. I'm sorry. And trusts are easy. They're they're far less expensive in the long run than doing just a standard old will or not having a plan. But they set up a very simple trust that was insured. Like there was insurance on their lives and they had some assets. And they said that what we want our trustee to do for our descendants is to pay for them to leave the country for 2 weeks every year and allow them to experience a different country every year. And so we drafted up a plan that kind of did that. That one stuck with me because their future generations, and there's enough money where they're going to be able to go travel around. I don't know about you. When I was growing up, travel for us was we got in a car and we drove to another state, and that was our vacation. It was in a station wagon, and you travel, and then you stayed at a hotel somewhere, and that was your vacation. We didn't travel outside the country. I didn't do that until I was far older. I did get to do some travel with sports, but never like fun travel, go where I wanted to go. And when I was able to do that, it did change my perspective. It is an eye-opening experience. And I was like, gosh, that would be really cool if I was growing up. And at 16, they said, hey, the family's going to go to Paris, or the family's going to go to London, or Madrid, or it's going to go to Mallorca, or it's going to go to Greece. It's going to go to Athens, or we're going to look at ruins, or we're going to go to Normandy, or we're going to go to Canada. It doesn't really matter. We're going to go down to Mexico. We're going to go to Colombia. We're going to go to Peru, whatever it is. I'm getting out of my comfort zone and I'm seeing the world. And I said, that would be pretty cool. I'd remember that. Again, I'm not a recipient of anything, not any of that in my family. And so I kind of look at it going, gosh, that would have been pretty cool. So when I'm working with clients, I'm always thinking like, I like that way. There's the straight education people. I want my kids to go to college. I always want them to, to get the best opportunity. And I'm like, okay, I get that. Education, trust, health, education, maintenance, and support. I get it. We can do that in our sleep. But what's really cool is when somebody says, I want you to do this. And I love nonprofits for that reason. I love family foundations when they bring their kids and put them on the board so that they're living something and they're giving it away. I love that stuff because it's not just money. Yeah. You're giving somebody values.
It's interesting that you say that because growing up, some of the best memories that I have of my childhood are when we went on trips. Yep. And it's something about, maybe it's because you're going outside the day to day and you're experiencing something new. But as you were talking, I was just playing in my mind all the trips that I went on as a family, and how cool would that be? And it's probably a lot cheaper than maybe someone might think to be able to make something like that happen. And yet, how cool would it be to work in such a way that generation 3 or 4 is experiencing that experience, but then it automatically ties back to you. And it's not maybe just remembering your name, just to remember your name, but it's remembering the values that you have. And that's all possible by doing some of this planning. Anything you want to mention before I go? I almost have like a three pillars that we can focus on in the rest of our conversation.
I would say that I want to say that Steve Harvey, and you probably have that link. I think I shared it.
Yeah, we can play it as well, just so that people
go watch it.
Yeah,
because he said that's how I'm going to live my life, is so my kids, grandkids know my name, and that was a driver. I think he's achieved it. I think anybody would say that if Steve Harvey would say, Yeah, I mean, everybody knows the name, I mean, not a secret. But he did it deliberately and with, maybe that's not what you wanna do, but what he did is he said, "This is what I'm gonna live my life like, and this is how I'm gonna communicate to my kids and my grandkids and my great-grandkids." Those are values, and I think that's really important to pass down, not just to willy-nilly, "Here's my cash, I leave my house to this, and here's my brokerage account."
Yeah.
That's okay, that's that's this level. You wanna go up here and you wanna really make a difference, put a little thought into it.
Yeah. All right. So with our time together, I'm thinking of like, I'm genuinely curious about some of these next things I'm going to ask you. I'm
Mm,
curious when it comes to tax strategies, the best ways that you've seen or frameworks on how people keep their money. So that's a pillar number one that we're going to talk about. Pillar number
mhm,
two is better ways to invest, like assets. I know you mentioned the stock market, like figure out automation and then forget the password. I'm curious if there's other assets out there that you're seeing that are valuable. And then the
mhm.
last thing is I would love to do a mini just pick your brain around estate planning and how someone can do a living trust and like how even from a tax attorney's perspective, like what that means and are there levels. So as we get started, you're making money and obviously you're pretty clear. It's like, hey, you make money. There's some people that are watching or listening to this that should find other ways to provide value and skill sets. We could probably talk a lot about that, but we're not. But
Mhm.
there's ways of making money. Okay, so now you're making money and now you're asking the question, Toby, from a tax attorney's perspective, how can I keep more of what I'm earning by understanding the tax game? How would you answer that?
Yeah, I would say you use a framework like this, and I use this example. So if you've heard it, I apologize. But it stuck with me for almost 30 years now. You fly into Orlando Airport, and you're going to go to Disney World, and so you rent a car, and you get in the car, and you start driving, and you look for the signs that say this way to Disney World, and you get on that road. And as you drive down that road, it's taking pictures of your license plate and they're sending you a bill and it's toll road. And it used to be when I started this, you stopped at what looks like a urinal and you throw a quarter in it. They don't do that anymore. They've made it really easy to take money out of you. They just send you a text saying, "Hey, you owe me this much money," the toll road thing. There was a road right outside of, so you still get to Disney World. Fantastic. And it costs you some dollars. There's an exit right when you get out of Orlando Airport, it's Sand Lake Road. That's a surface street that goes to Disney World, and it's free. You don't have those tolls, but there's no signs to it. Nowadays, you can use an app, and you can go to Google Maps and you can say avoid tolls, and then it'll show you the road. Back in the day, you used to have to know somebody that knew that road existed, and they would tell you, "Hey, Caleb, if you're going to Disney World, you don't need to go on the toll roads. They're going to rip you off. Go this way." And taxes are the same thing. Taxes, there's usually one or two or three or four paths that you can go down. So like if you and I were setting up a business and we set up a marketing business and we both made 100 grand a year, depending on how I set that up from a tax standpoint, I may be keeping an extra $10,000 a year more than you. And that may not sound like much, but over 10 years, that's an entire year's pay of gross income. But it might be half of the net, right? It could be the difference between actually being able to retire versus having to work your entire life. And it's just knowing that there's that pathway that is the no tax pathway and avoiding the toll roads unless you really want to go on the toll roads. And I use an example like this. If you were driving across town and you put in a destination into your Google Maps or Apple, whatever it is, and it said there's three ways to get there. There's a way that's 10 minutes and it's going to cost you $10. There's a way that's 15 minutes and it's going to be free. And then there's another way that's 12 minutes and it's going to cost you $1. That's the tax world in a nutshell. They usually just, so some people are like, "I pay no tax." I'm like, "You're an idiot. You don't either. You're lying." Right? Everybody pays some tax. If you're getting, there's gurus out there. I make $1 million a year in salary and I pay no tax. No tax. No, I'm a real estate professional. And I'm just like, you're lying because you're paying employment taxes, which was, by the way, like that's a huge chunk of our revenue. You're paying state taxes because not all states have reciprocity and the bonus depreciation. You have recapture that they never mention. I rolled off my G-Wagon. And well, what about the recapture when you fall below 50% business uses or when you dispose of the vehicle? They never mention that stuff. And they just keep you in this. It's just this whole, I never pay tax, therefore I'm really smart. And it's like, well, good luck getting a mortgage if you want to try to buy a house for your family if you have no income. But I'm a tax guy. I'm doing it. They're going to look at you like you're a tax cheat. So I always look at this and say, you need to know what the paths are and you need to know the pluses and minuses for all of it. And that's tax planning to me is making educated decisions. So you could choose, because there is a situation where I'm like, if I can get to a location in half the time and it costs me money, my time is worth more than that money. I will do it. And somebody else might say, I really need that money. So I'm willing to take a few more minutes and have a couple red lights. Okay.
We've helped people unlock millions of dollars in hidden value just by reviewing their old life insurance policies. Unfortunately, thousands of people do not have life insurance policies set up properly, which could be costing them a lot of money. If you have a policy, the few minutes it takes to fill out our form could be the difference between continuing to waste money or unlocking serious value. If you qualify, we'll review your policy 100% for free and give you the honest breakdown you deserve. Click the link in the description or take comment below to apply. Back to the video.
I love that analogy, and I've actually never heard that. So thank you for sharing. My next question, which you kind of already jumped to the chase, on TikTok, on YouTube, there's a lot of noise, and you probably have a very unique experience because you're like, oh, these people are lying, or they're over exaggerating, and they're making everything look bad, and they're potentially creating. There's a lot of consequences that come from making statements like that. Are there any strategies that you were like, okay, not that we're going to go into it on this video, but you should look into, like when it comes to entity stuff? Do you like depreciation, or do you think it's overhype? Should everyone, even if you're W-2, set up a business? Like, what are some of the core strategies that people should at least be aware of to do more research on? And then what are some of the strategies that you're like, this is mostly hype and be cautious?
Yeah, the big ones are real estate professional status, short-term rental loophole, all these things. And you always have to be cognizant that you don't just, if you can create a loss, that's great. Now, can I use it? Is there a cap on it? And again, not to beat on these people, but you got these folks out there saying that they're making $1 million and they don't pay any tax because they wrote it all off because they're a real estate professional. I'm like, that's not a thing. If you're taking a W-2 salary and you're offsetting it, there's the net business income limit or loss limitations. Like you can't actually write off that much money off of this strategy. So I know they're not being honest. And I'm always like, well, if you're not honest about that, then what else are you lying about? And so I see that over and over, and their whole response is always going to be, oh, they're just a hater. They're drinking haterade and I'm popular. And it's like, no, just give people the skinny. It's, taxes are complicated. I wish they were easy. I wish you didn't need tax attorneys like me. That would be really, really cool, but they are complicated and there's ramifications to your decisions and you have to do so with your eyes open. Yes, there are some great things you could do. You're making $100,000 a year, in the same business. You're a sole proprietorship and I'm an S corp, right? They'll do funny math and they'll say, well, see, I avoided the self-employment tax. It's 15.3%. Well, you can write off half of that self-employment tax. Come on. It's not $15,000. It's like $14,100, but you have to take a salary. And because you take that salary, you're going to lose the 20% 199A business deduction. There's a math calculation. It's not what everybody says. It's not as bad and it's not as good, right? But there's a ramification as a sole proprietor. You're, in some cases, more than 1,000% more likely to get audited, and you're going to lose that audit 95% of the time. And those are IRS stats. That was off of their publication 55. The last year they published the stats was, I think, 2019. And you can see it. And you're like, okay, maybe I don't want to get audited. Maybe that's going to go into my calculus. They almost never, it was an asterisk one year for S Corps. Like it's a fraction of a percent. Maybe I should be an S Corp so I don't get audited. Maybe I should be an S Corp because I can pay myself a salary and I can do an accountable plan. I can do an administrative office for the home rather than the home office deduction. Maybe I want to do this. I could do a 401k with it. And there's lots of reasons but it's not $15,000, and it's like, it's not as simple as what people are saying. And there is a complexity to it. So you got to talk to somebody who knows what they're doing. And usually they're like, hey, I've done this 1,000 times. Caleb, look at your situation. I know exactly where you're going to end up. Here's the skinny. Here's what you're deciding. And it's no difference than any profession. If somebody knows just enough to be dangerous, man, they share that with everybody. I got this new thing called Amway, and I'm going to tell everybody about it. And you're like, it's been around for a while, and it's not as good as what they're saying.
Is there any strategies out there? You just mentioned, like, and I appreciate what you mentioned about the entities, because I've seen some TikToks where they're pretty much the pitch is you should be in an S corp, and it's like, okay, and they're only sharing the tax that you're saving, and then but they're not mentioning the extra costs that it's going to bring in. They're not mentioning the reasonable. I feel like sometimes this reasonable salary thing just goes out the window. It's like, maybe you could speak from experience, but I don't feel comfortable essentially saying that your salary is going to be $1,000 a month. So you got to be realistic. So I appreciate you mentioning that there might be other benefits though, and quantifying that versus usually the whole pitch is this is going to save you money on tax. There's a world where it might, but there's a world where it might not, but you still want to do it for X, Y, and Z, and those things never get talked about. Is there any other strategies that you would say, if you're watching or listening to this, do some research on this more, like maybe like the Augusta rule, or do you recommend getting a G-Wagon, or do you feel like more people are hurt by
My wife
spending
drives
money
one.
to avoid tax? You're spending $100,000 to avoid $30,000 worth of tax.
Well, you're going to end up paying the tax no matter what. So the way depreciation works is you get to take it and then you get to recapture it when you sell or get rid of the item. So it's like people that, I wrote off my house and and my rental property, and then they go to sell it, and it's like, unless you 1031 exchange it, you're going to have recapture. You could do the lazy man's 1031 exchange, which is to do that and then go ahead and go and buy another property and create a loss that you can use to offset it. But you got to have basis, and you got to be at risk, which they never talk about. Section 465, they never mention that. In the sub 2 guys always want to go, psh, 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 psh. You're not even at risk. You can't write. You don't even get to the passive activity loss rules unless you pass those gates. But I will say this, like on the S corp, preserve, protect, prosper, right? Can we preserve the asset and make sure we don't have a hole in the boat? Can we protect it from lawyers and snoops? Yeah. So we always want to have a box around our business, because even if I set up, let's say Toby the plumber, I go buy some low cut Levi's and some tools, and I start being a plumber. Then I have liability that comes along with that. What if I flood somebody's house and I do $1 million of damage? I want to make sure they can't take my other things. So you always put a box behind it or a box around it so that it can't get to you. That's called inside liability. That's before you even get to tax. And then you look at the tax side and say, all right, what's the best way to tax this? If I'm going to sell that business and my intent is to build something up and I'm going to keep the money in the business, I might be a C corp, especially if I have other income and I'm married to somebody who's a high earner. I may be telling you to be a C corp so you can have, because there's 1202 stock, you don't have to pay taxes up to $15 million, or it's actually higher than that. It can be a multiple of the basis. I've had one person exit with a $40 million business and pay zero tax on the capital gains as a result of that, because they were set up as the C corp instead of the automatic S corp. There's the S corp, and you look at that and say, but I got to take a reasonable salary, which means I'm doing payroll. With both corporate structures, S corp or C corp, I get an accountable plan where I can reimburse myself some things, tax-free. The administrative office for the home doesn't show up on a separate form like it does if you're a sole proprietor, but you do have to pay yourself this reasonable salary if you're an S corp. The court cases tell us, hey, third, everybody kind of uses this general rule of thumb, but it is supposed to be reasonable, customary, and necessary for that profession. Yeah. And so you want to make sure it's somebody looking at it saying, here's what I think a reasonable salary is, so you can base it off as something. Because if you end up in an audit, the IRS would love just to say, hey, we're just going to ignore the S. It's all taxable to you. It's all employment tax and everything because you didn't follow the basics. So you want to have somebody kind of guiding you along that line. I know I just threw a bunch at you. I would tell you that one of my favorite tax deductions right now is HSAs. It's a triple threat because you get a deduction, it grows tax free, and you never pay tax on it so long as you use it for for health. Those things are fantastic. I love nonprofits because it gets it out of your state. So if you're a rich person, there's, the ability to do a donor advised fund, set up your own, trade those monies, let it grow really huge, and fund your own nonprofit, which you can't do at a traditional brokerage house. You got to do this with somebody who knows what they're doing. You could literally set something up that is outside your estate that you get a tax deduction for your whole life, and then it creates your legacy. It could be something that you really care about. It could be animals. It could be health. It could be education. It could be volleyball. I have a buddy who built an actual stadium and coaches and stuff, and that's where he puts his money, but he's able to get a tax deduction doing it without playing all these games. There's so many things out there. There's about 50 different strategies I keep in my back pocket that you just start saying, all right, let's apply it to facts. Bonus depreciation is a big one under the One Big Beautiful Bill. It's 100%, but it just means you're writing it off faster. You'd still get to write it off, but you're just writing it off faster. And so the question is, should I? Well, there's 3 rules in tax. Calculate, calculate, calculate. There you go. All 3 of them. You got to figure out whether it's worth it. If it's not worth it, don't do it. You're just throwing money away. And stop listening to TikTok. Those guys are usually selling.
For those people that are like, okay, I'm sold on not the overhype. How do I determine if the person I'm working with, when it comes to taxes, is the right person? Like, is there a question? Is it calculate? But the problem is, if I don't know what to calculate, I'm still at square one. How would you answer that?
If I want to learn how to fish, I want to go with somebody who's experienced at fishing. I don't want somebody who read about it in a book and then says, this is how you catch fish. So I want to work with somebody who's done it. I want to be with a firm that's what they do.
Yeah.
I don't want to be with people that they're learning on my dime and they're going to miss it. Real estate professional status has been around for a long time. It's 469. It's not new. It's new on TikTok. But people have known about it. It's just, it wasn't that huge of a deal because we didn't have the bonus depreciation like we do now. And all of a sudden it's like, hey, during COVID, we could carry it back 5 years. I mean, we could go get money back. Well, that's not a thing now. So should we be doing it? Should I be doing it on a single family residence? Should I be doing it on my commercial property? We used to use it very targeted, so I use it because I'm a real estate investor. I got over, with my partner and I, hundreds of properties, commercial, apartments, single family. I've had them burned down. I've had all sorts of fun stuff happen. I've had I've had people drive into the house. I've had sinkholes, I've had floods. I had a tree fall on one. There's a different perspective when you've done it. And it's not all, well, this is what you do. I read about it and I'm really excited about it. And I get that. But you want to talk to somebody who's measured, who's going to say, here's the good, the bad, and the ugly, Caleb. This is why you do this. And let's see if it benefits you. Hey, yes. Hey, Caleb, this could benefit you $5,000 a year if you do it. And then you say, is the juice worth the squeeze? What do I have to do? And if I say, well, you're going to spend $2,500 a year doing compliance and having to do this and that and the other, you might say, yeah, I think I'd rather not. It's kind of like, again, we're driving across town and I could save myself the toll, but it's going to take me half an hour versus 10 minutes. I think I'll just pay the toll and drive in 10 minutes.
Beautifully said. Beautifully said. Let's now move on to the grow section. And I'm curious, you mentioned putting your money in, indexes. What are some of your other favorite assets for building wealth?
Well, I think you look back and like history is a really good teacher, right? So I believe that the most liquid and easy asset to get in and out of is going to be securities. So I'm going to start there because I don't know what life is going to throw at you. You could have a health crisis. You could have parents that need money. You could have an animal that gets sick and you need money. And if it's in a house, good luck. Somebody will say, well, you could borrow against it. Good luck refining that $75,000 rental or, whatever. When you need money, it's kind of tough to get some of these things and it might take a little while. Whereas a stock I can sell and I can be out of in 2 or 3 days, or you could borrow against it with security-backed line of credit and I could just have that money, boom, immediately without even having to sell. So I tend to start with that easiest. And then I move to the next easiest, which is real estate. And a bunch of you guys are going to look at me like I'm crazy. Like, real estate, that's hard. Well, trade like a security, and you can expose yourself to real estate by doing real estate investment trusts like Federal Realty Trust and and Public Storage and these types of things. And it's just like a stock. And then I say like, hey, start with 50,000, try to get $50,000 into your trading account. Learn how to do covered calls, learn how to do the wheel strategy, learn how to get into dividend. There's companies that have been paying dividends, increasing dividends every year for 50 years or more, called Dividend Kings. Every year they raise the amount that they're paying you. You get a raise every year. There's a handful of them, right? Those are pretty good things to get into because, hey, I'm getting paid. And, they've gone through some cycles. We know they're not a fad, so you're not going to get crushed if the market corrects. Then you go to the real estate side and you go into that kissing cousin of the stocks, which is the REITs. Then I say you go to managed money. When I say managed money, it means somebody else is managing or making the decision. So it might be that you mirror a portfolio of somebody if you want to do it on the cheap, where you just say like, let me see, Berkshire Hathaway's portfolio, or just give it to Berkshire Hathaway, buy the shares. Or I have a money manager. I have somebody that manages, and everybody says, well, they're a ripoff. No, they're really a good source of information. When you have a good financial planner and you have a good fiduciary, somebody who has to put your needs in front of their own, they're a wealth of information that's going to give you great ideas and give you the opportunity to grow. And you kind of go that side. I do have another bucket. I call it 30, 30, 30, 10. So 30% in stocks, 30% in real estate or real estate equivalents, 30% in managed monies or mirrored portfolios, or syndications fall into that realm when somebody's, somebody else is running it. Then 10% is in your gold, silver, cash or cash equivalents, your US dollars, your Bitcoin. It's a smaller percentage. And you notice I'm not saying everything into one thing, because money is a little bit like poop. If you put it all in one big pile, it usually stinks. But if you spread it around, stuff grows.
That is one big pile of shit.
So, and I stole that from somebody else, but I happen to think it's very true. It's not this whole diversification thing, because I always hear somebody saying like, oh, they're really wealthy. They're not diversified. Warren Buffett wasn't diversified. Yeah, he had different types of wealth. He spread it around, but yeah, he was concentrated on a business. But you're not Warren Buffett necessarily. Like, he's also willing to take a huge risk and put all of his eggs in one basket. Elon Musk, he does a lot of different things. Jeff Bezos does a lot of different things. Did they have concentrated wealth? Yes. But my experience with most people is you want to spread it around. So if there's a correction in the stock market, it doesn't destroy you. If there's a correction like we had in 2008 in real estate, it doesn't destroy you. If you have syndications go bad, which happens all the time, it doesn't destroy you. You're not putting all your money into one thing, and you're not chasing Bitcoin. The Bitcoin bros just got humbled. Everybody was doing the Bitcoin. A lot of people just got hammered as a result.
Yeah. They're using leverage on top of this, and it only amplifies the problem when things go south. I think of it as like double D's: due diligence and diversification. And if you do both of those, you're gonna have better results than the person that doesn't do due diligence and doesn't actively diversify. So love that you mentioned that. And one of the reasons I love your content is you're very good at talking about, here's the pros, here's the cons, and take it or leave it. You're very education focused, and I think that is one of the reasons why you have such a growing platform, is people trust you, and you have a track record of trust. You had a video recently where you talked about the buy, borrow, die strategy, and I would love for you to maybe articulate what that is in 1 or 2 minutes. And then, do you think the strategy is a good strategy for people to use, or do you think it does more damage than good? Because that's another thing that a lot of people are talking about. And normally people use it to sell something: real estate, insurance, something like. Usually you have to be very careful on what's the agenda behind why someone is telling me this quote unquote strategy. That's why I like first principles. But I'm just curious your definition of that. And do you think it's a strategy worth pursuing, or do you think it does more damage than good in the long run?
Well, I'm going to say first off, I'm not a fan of debt. So I tend to not like debt. I am a fan of assets. And I am a fan of not paying tax on a bunch of stuff if I can avoid it. And so the buy, borrow, die strategy is really simple. It's allowing you to control something like your stock portfolio and allow it to grow. And you might say, hey, I have another opportunity. I have an opportunity to buy a property. I've actually done this. So I could just say I had a commercial warehouse here in Las Vegas, and there was 3 buyers trying to come in, and I wanted just to muscle them out and say, I will close next week with cash. Nobody else could do that. But, I just borrowed against my stock account. I just said I had a security backed line of credit. It was a lot cheaper than a traditional mortgage, but I was able to get liquidity like that without selling anything. I didn't want to sell anything because if I sold something, there's a cash drag and there's a transaction cost. So it's really the buy, borrow, die something is buy an asset, let it appreciate over many years. If I never sell it, I never pay any tax on it. And if I die while holding that asset, its basis steps up to the fair market value when I died. What that means is that if you were my child, Caleb, and I have a house and I bought it for $100,000 and it's now worth $5 million because I've held it for 30 years. If I died, the value that you would receive that house at, its basis would be $5 million. So if you sold it for $5 million, the next day you'd pay 0 tax. If I sold that house during my lifetime, I may pay 23.8%, whatever, on that house. So I'd lose a bunch, plus I'd have the commissions, plus I'd have the real estate transfer taxes. There'd be a drag of, let's say, 25, 30% on it. So what the buy, borrow, die strategy says is instead of selling it, Toby, borrow against it. So same scenario, bought a house for 100,000, 30 years later, it's worth 5 million. And I have other opportunities that I want to take advantage of. I want to go buy a business. I want to invest. Maybe I just want to go on vacation, or I want to pay for my grandkids' college education. And I borrow $1 million. I pay 0 tax on that. And then when I die, I pay 0 tax. So I managed to have appreciation of $4.9 million. I managed to use some of it while I was alive and transfer it to somebody else after I pass and paid 0 tax. That's the buy, borrow, die strategy. And it works on multiple assets. It can work on art. It can work on real estate. It can work on insurance. There's the cash value, where I build up the cash value in a whole life or an index universal life. I know you're not a fan of, but I let those things grow in value, and then I borrow against it, because borrowing is not part of, I think it's Section 61 of the Internal Revenue Code. That does not count as income. So if I did not convert that wealth and I just borrowed against it, tax-free. So I can borrow against assets and not pay tax on it. And that's sometimes a play. Sometimes it's not. Sometimes you're looking at it going, wait, you lost money on it anyway. You wouldn't pay any tax. Why are you trying to lever it even further? Like, you're burying yourself into the ground. Stop it. Other people are looking at it. And again, 3 rules: calculate, calculate, calculate. You're looking at it saying, all right, I need this money. What should I do? Well, I could do this. I could do this. I could do this. Oh boy, look at this one. I get the biggest bang for my buck if I do this. And the buy, borrow, die strategy works for people that have huge amounts of concentrated wealth. Like if you're a founder in a company, you got $30 million of shares, but it's not liquid. Like I don't have $30 million, but I want to buy a new house. I might borrow against the shares because it's so much easier. And then maybe I never pay it back.
Yep.
All I have to do is die, and then I pay back the loan after I'm dead. When the house sells at that point, or I have life insurance that pays it off, or I have something else, right? It's part of a plan at that point.
Yeah, I love it. And I think it goes back to, like, you got 40 to 50 strategies in your back pocket, and calculate. Does this make sense? What are the pros? What are the cons? And I appreciate you articulating that. Let's go to the last section, which is protect. And there's almost like two things I have questions around. First is this concept of asset protection. And so how can you make your assets invisible from creditors, the government, lawsuits? Like, is there like a go-to, do this thing or research this to become a pro at asset protection?
You got to talk to somebody who's done it. And so, like, our firm, that's what we do. We've been doing it for close to 30 years. So I would say, come to a free class, right? That's easy. Or come to my channel and, spend some time there. There's only 1,200 videos or so. So you could lose a year pretty quick. I would say this. Erase the idea of hiding it from the government because it's going to be on your taxes. And so whenever we hear about FinCEN and this new real estate reporting rule and the Corporate Transparency Act, when that was a thing, I always said it's going to the Treasury. You're already giving it to the Treasury. Knock it off. When you open up a bank account, they have know your client. That you don't think that they're sharing that information, you knucklehead? Come on. And they're like, it's Big Brother. I'm like, I get it. That's what it feels like, but you're not hiding from the government. You're reporting it on your taxes. They know. So I'm like, stop being like that. That's not a thing. They're not coming to get you yet. Right. I'm coming to get you. That with that token though, from a public record standpoint, nobody needs to know what you own. It's just, you can get your name off of real estate. You can get your name off of businesses. There's no reason to sit out there in a public record. So if I look you up and I say, hey, Caleb, I wonder what he's got. And I find that you own 20 houses and I think Caleb's a rich guy. And I'm a billboard lawyer. And my nickname's the Hammer. Caleb's the Nail, right? And I don't want my clients to be the nail. And so I'm like, I don't want them to see it. And by the way, I say, talk to somebody who's done it. I have clients that had a business together. They were related. I won't give you too much because you could figure it out because it was a big case in the news. One of the family members got out quick out of that lawsuit. It was a big case. It was a catastrophic injury. The other, no, they got drugged through 4 years in a massive settlement. Our client was the one that got out quick because they thought he was poor. They couldn't see what he had. And so they took a peppercorn settlement. He got out quick for a small amount.
Yeah.
They couldn't see it. And the punchline is our guy was wealthier than the other guy.
Yeah. Wow.
His other relative. And it's like, I don't like that that's part of the calculus, but it is. The calculus is really simple. What is the claim worth on the best of all days? What are my chances of getting that? Multiply that. That gives me a dollar figure. Then multiply that by what my chances of collection are. Take costs off of that in time, and you got a settlement value. So if your chances of collecting are zero because you have a good structure in place, and I say you do need to have walls. You want to have the smoke screen, you want to have invisibility, but you also want to have walls that will hold up. The moat around your castle is the insurance, but the walls are the LLCs, the trusts, the things that actually shield the attackers that are trying to climb into your castle. You still want those. You put those in place, you're not going to, your chances of success are infinitely higher. What you would love to have is to never know they would even look at you. They never even tried to cross your moat because they didn't see it. It's like Wonder Woman's Island where they were all hidden behind the veil of fog. You want the veil of fog so they never know you're there, because if they know you're there, they may try to visit.
I love it. Maybe you can give us a link for, if you want to learn more, one of your master classes, and obviously check out Toby's channel. And maybe we'll have you back on to do a deep dive into that. But I appreciate that. I've written some things down. Get your name off of assets. Make it harder for people to see, because at the end of the day, that's what you're really trying to do. Is if someone's not going to sue I mean, this is like a really bad example, but it's a long story. I've loaned a very small amount of money to somebody who ran off, but there's like nothing for me to go after. And so it's just like, I don't even lose sleep about it. It's like, okay, it is what it is. That would have been a lot different if this person had something to lose, even like from a credibility standpoint. And so if that's like a very minor example, but you can position yourself in a way where you might look more of like, hey, that's not worth my time to go after someone who's like, even if I win, what are they going to do about it? Versus you being super showy. It's like, I'm an investor. I'm going to invest in the ability for this thing to pay out. So I love that. When it comes to living trust, you mentioned this versus like wills. It was funny. I'm in the airport and I see a machine that you can like go type in and get your like will, like you're afraid that you're going to die on a plane or something. It like cracked me up, and there was actually someone there like doing something. And I was like, I can't believe people do this. So obviously there's that aspect, and there's people that can go and get a will for $100, $200, $300 on websites. What's the difference between that and like actually doing estate planning, and when should you start? You mentioned early on that even if you're not super wealthy, you should get started. What's the thing that we should know when it comes to living trust? Because this is one of the things that you're like most known for when it comes to your education and helping people.
Yeah, I would say that you kind of have three categories: the do nothing, the do the will, and the do the trust. Really, what it comes down to is a lot of folks think that a will is actually the same thing as a trust, that it's just a different way of distributing assets. And what I would say is your estate is a lot more than just your passing. Your estate is your life. And when you're using a living trust, it's about what occurs during your lifetime before you pass, just as much as it is about the end of your life. Hey, do I have provisions about who can be there with me, who can make decisions on my behalf if I'm not able to, who can handle my finances if I'm not able to? Because if you don't, you're in a conservatorship and you're in a mess, and you have loved ones like one of our attorneys who really left an impression on me. Her fiance was killed in a car accident, and she was at the hospital trying to see him before he passed. She wasn't family. They did not let her visit him before he passed, and he passed away. It's still, it was something that haunted her, right? And it's like, that's why you have an estate plan. Sometimes you're not married. You should have something document to say, here's who can come in and speak for me, and here's who can advocate for me, all those things. A will does not do that. Doing nothing does not do that. The only thing that does that is to have an actual estate plan. I call it a living trust because if you're doing all that, you do it all at once. And Caleb, I'll do this. I have an emergency binder that I give away to everybody. I'll give you the link. If you want to share it, you can.
I totally, thank you.
And what it is it's an organizer of what's your social media accounts, who's your doctor, dentist, where are your animals, where do they go to the vet, if you have children, who are their friends, what schools do they go to, all those things that if something happened to you, and God forbid it happened to you and your spouse, how would somebody even know where to start? Where are your bank accounts?
Yeah.
What's my financial plan? All of those things. How do I get into social media? I had a friend pass away this time last year. I ended up probating his estate. We're still doing it, of course, because he wouldn't listen to me, a little knucklehead. But the way I found out was somebody reaching out to me through a Facebook account that was an ex-girlfriend of his saying, hey, I think your friend may have passed away, because he had nothing. Thank God we were able to. And then nobody could get into any of his accounts. Nobody could let people know. Nobody knew where he was banking. Nobody knew where, it was a piecing it together. It was private investigators. It was going to homes. It was looking for things. And he was in multiple states. So it was a bit of a nightmare. And one little emergency binder that lists everything. And it would have been great to know, hey, this is where your stuff is. It would have been, and it's free, so there's no excuse now, for people.
I love it. Thank you. We'll have that link in the description. Toby, thank you. I have so many other questions. We'll have to have you back on because I know YouTube removed a video recently and then you reached out to them and they actually reinstated it. That's a whole nother conversation. I am curious, based on what you said about assets and the veil, should we not be saying certain things to certain people? Like, what should we not talk about with people about our finances? Like, should we be more private? And is there any do never share this with people on the internet or share this with people that you know? Or what is your just thoughts on that when it comes to asset protection?
Yeah, I think the more you share with people, the more chance they're going to use it against you. That's just what I think.
Okay.
I think you don't tell people what you make. You don't tell people what you're worth unless it's somebody that there's a reason for it, but I wouldn't be bragging about it on social media because people will target you. And I've had clients that have had that happen. I've had friends that have happened. And then there's not a divorce lawyer in this town that won't tell you the first thing they do is grab all the posts from Facebook and Instagram and TikTok and say, let's see what juicy nuggets we have to beat the other party up over the head with. Yeah. So you got to be careful about what you put out there in the public. If you post it, expect it's going to be there forever. The internet's forever. And so just be careful that you're not inadvertently putting a bullseye on your back. And I'll kind of say it like this. A very good friend of mine has been in insurance for a long period of time. And they say this to all their doctor clients. If you get in a car accident, don't tell anybody you're a doctor. Don't immediately say I'm a doctor. Why? Because you're going to get the lightning suit out of you. That's just how it is.
Yeah.
You just increased your chances, at least, of getting a crazy lawsuit that's going to drag you through the muck. And what they're going to try to do is get over to your personal assets, which they'll defeat your insurance in some way or some other. They'll plead other things. You know, you were doing something intentional, or you were really negligent. You know, you were texting or whatever it is, and they'll try to get through something, or they'll make an extraordinary claim. I have a video. It was an $87 Costco bumper tap that became a $3 million lawsuit. The average jury verdict coming out of the federal courts right now is over $16 million, according to stats. People don't understand that they're rolling the dice and that these juries are kind of nuts. And if they think you're rich, there's a lot of times where the jury goes, yeah, I think I'll give it to this person, just to, you know, and it's not a fair system right now. You know, there's reasons not to interact with it. And I would just say, because it's a crapshoot and there's really good lawyers out there that will make you sound really horrible and that somebody should have your money. Try to avoid that. If you never go to court, you didn't miss anything. Not much good stuff goes on in those places anyway. Watch it on TV because it's not real. Don't go yourself.
Toby Mathis, everybody. He's going to help you spend less days in court and more days with doing the things that you love. Toby, I can't thank you enough. I'm very grateful for you giving us this masterclass on how to keep, protect, grow. I love how you mentioned preserve, protect, prosper. I love that. And I'm very grateful for our new friendship. And thank you again. We'll include your YouTube channel and all the things that you mentioned. And I don't know about you. I feel convicted that I need to do a better job with asset protection. And so that's one of my takeaways is be more intentional when it comes to that. Anything you want to say before we land the plane?
No, appreciate you having me on. And again, guys, put stuff down in the comments. I'll pop into your comments. If anybody has questions, I'd be happy to go in there and respond back. But, put your head down. Usually you have a gut reaction when somebody's telling you something that might be too good to be true. It's probably true. And just surround yourself with people that are measured, that have been there, done that. They're usually willing to share their time and their experience with you. You'd be surprised. Not everybody, you don't have to pay everybody 50 grand to be part of some master class. You could usually, good mentors will just show up and give it to you.
Thank you, Toby.